Hi, everyone. I'm Samantha Shue with Origin Point Mortgage. I know a lot of you on here already, but I don't know all of you. So thanks for introducing yourself. I'm a top loan originator, top 5% in the country, and I work for Origin Point. We're a direct lender. We're not a bank. And I love doing these calls with Shannon. We've been doing them probably going on 4 years now, and maybe 5. It's insane. We've been doing some classes together for so long, and I always learn something from Shannon. And if you guys have any questions at the end, I'll definitely be here as well. But we'll be talking today about what we expect to have happen this year. For me, will be from a rate perspective, and then from Shannon from a real estate perspective. Anyway, really happy to be here. I have my own house in Westlake Village. I moved from the west side at Brentwood in 2020, sold my house there and bought a new one in Westlake with my 2 kids and my husband. And I love Belgian waffles. So you go ahead, Shannon.
All right. My name is Shannon Shue. Let me go to the next slide. I forgot we have this slide. Sorry, Sam. My name is Shannon Shue. I'm a real estate agent with Keller Williams. In my office is in Marina Del Rey, but I'm in the group that's also includes like Santa Monica, Brentwood, Palisades. And so I invest in real estate myself as an agent. I've been blessed enough and grateful that I have moved into some of the top tier agents in the country. That's all because I have awesome clients like Stacy on the call, and maybe Neil will join us again. And I like a big part of like my message is, you know, real estate is a good way to invest in your future. And then that appreciation allows you to do other things in your life. I have 16 units myself in a self-storage facility. And some of you are on this call are agents with Keller Williams or familiar with Keller Williams. I'll be speaking at Family Reunion. 2 different sessions I'll be speaking at. One is how to invest in real estate as a realtor, and the second one is how I organize my team. So just grateful that I get also opportunities to speak. I love Vietnamese spring rolls, and I took up rock climbing again after a 17-year break last year, and I've been rock climbing about two times a week, and I've been going outside a little bit more. So that's me in a nutshell.
That's so great, Shannon. I'm excited to hear how it goes when you have your speaking engagement soon.
Yeah. Okay. We did the introductions already just because we kind of wanted to give a little bit of time for people to come trickle in. So is there anything, maybe this is one question before we get started, is there anything about 2023 you would really like to learn? Because instead of answering the question at the end, maybe we can make sure our some of the data we're going to show you, there's so much information that we've sort of highlighted certain things, but it might be nice to hear what you're interested in, because some of the data we can probably insert some of your thoughts. So does anybody here have like a question? Stacy, go ahead, my dear.
What are the possibilities that we'll ever get back to the kind of interest rates we just came from?
Ooh, that's a good one.
That's a good one. We'll be covering that. We'll be covering
cover that.
Okay.
And I'm going to talk a little bit about.
Stay tuned, Stacy. Yeah.
Yes. Yes. Any other questions you guys really feel like are pressing? Stacy, do you have any more? You and I kind of chatted via email. We have like a tier 2 question.
You know, not really. We're just not sure. We're not sure what we're gonna. You know, like I said, we're just not sure. I mean, when we moved up here, we assumed that this was going to be where we were going to stay, and now we're not sure. And so, you know, if I were to sell this house, I'd be concerned about interest rates because that impacts, you know, buyers. And if I were to buy somewhere else, same thing.
Right.
So.
Right. Okay. Good to know. And Sam or Austin, any questions you have as you look into 2023? Okie dokie.
Not right at the moment. Not right at the moment. If I do, I'll either drop it in the chat or I will write it down so I can ask.
Sure, and there'll be time at the end to ask more questions because I think what we're presenting might bring up more questions. But I also we think because we're looking into 2023, it's always good to know if there's something that you've been thinking about.
Okay.
Sure.
Yeah. So
one more question.
Yes.
One more
Sam.
question would be impact on rent. As you know, I'm now going to be managing my father-in-law's house.
Yes.
So I'm interested in that as well.
That I don't have too many slides on rent, but I'm just going to answer that question at the end because I think
Okay.
that's a good
No
question.
problem.
But yeah, I like where you're thinking. Some questions that I've been asking. So I'll answer my own question. Sam, maybe you have some questions or some thoughts about this question. I'll answer my own question. So my big thing for this year that I want to answer, that I'm both answering for myself in some of these slides, but just we can't cram it all in there. But a couple questions that are on my mind is this a good time for me to invest? And this is me, meaning Shannon Shue, me, right? Is there a way for me to understand what's happening in the market so I have very clear perspective for clients so they understand what I see so that they understand what can be applicable to their life, right? So it's kind of like, what Stacy and I sort of had some touch points before this. And then the third thing that's really important for me is to find the areas where we have great opportunities, but also be very realistic. It's like, I'm not going to always paint a rosy picture because I don't want real estate to always be like, well, let me only show you the upsides. I'm very happy. So the question for me is like, what are the downsides? Right. And be very real with myself and others so that we're looking very clear at the market. Sam, what about you?
I always like to hear your perspective on, is it a good time to buy or not? And so I am going to show you really for real what's happening right now. And I want to show you what's happening right now, but I also want you to see too, that because of what's happening right now and what's sort of expected in the future, it's silly, like come today and you're going to buy today. You actually might want to buy like sooner than later in the year. And the only reason we'll go into it in a little bit is that rates are starting to dip right now. And we'll talk a little bit more about how a lot of people are on the sidelines because they still think rates are higher, which they were in October, but the news really hasn't started covering the fact that rates are starting to come down. And so all those people who haven't bought yet, once they hear the news, they're all going to get in line to buy. And we're going to see a lot more properties that have multiple offers. I mean, even Shannon, you had like 2 weeks ago, you said you had a listing a couple of weeks ago that had 23 or 33 offers on it.
27. Yeah.
Still, right? That's insane, right? And I think a lot of you probably come into this call thought, oh yeah, like houses are just, maybe if a seller gets one buyer, that's a good thing. That's not what's happening right here. It just depends. But anyway, well, I don't want to let the cat out of the bag just yet. We have to, slowly get it out.
Okay, so guys, I'm going to give you sort of a brief overview of what's of December 2022 when we look at a market snapshot, because we went from a very high, we'll see some slides about kind of where the market has taken us. Like December is usually a low month, but this is ridiculously low for us, for the whole state of California. The price, I want you to kind of look down here. 774 was the average price point in December, but we're down 2.8% year to date. 2.8%, if you think about it, is not down very much. However, unsold inventory moving into January of 2023, which is this month, 2.7 months. So that's up 125%. That means that we are more than double where we were 1 year ago. On year to date increase in inventory that's just sitting, right? And then the median days on market is up hugely, 28 days. And you might think to yourself, wow, that's less than 30 days on market on average in the state of California, but that's up over 100% because sellers are often out asking for a price that would have worked just fine in May of 2022 and December 2022. It's not going to fly, right? So what we're seeing is that buyers are price sensitive. Yes, they will overpay, but will they go wildly over? No, they will go slightly over. And then they think to themselves, fine, someone else can have it. I don't want to pay that much, right? So yes, multiple offers are happening. I also have a listing that's just sitting because the seller wants a price that worked great in May of 2022, and I cannot get her down to a January 23 price. So stuff that's sitting is making this average on like days on market, still days on market, right? And so existing home sales is down by 23% year to date. So that's a huge, that tells you just in that snapshot that 23% of buyers went away. But then we have to think to ourselves, there's still 77% buyers that are here. They're not the same buyers from a year ago, but everybody cycles in and out. And so now we still have 77% of the buyer pool. And one of the things you'll see at the end of the slide deck is my predictions, but inventory is not going to go up that much this year. And so it's not going to go up that much, means the demand is still here. There are not enough homes to sell in Southern California. This is the Southern California snapshot, so it's more specific to Los Angeles, San Diego, you know, and anywhere from Santa Barbara south and all the way to the border with Arizona. And these are snapshots. This is data from the California Association of Realtors. The existing home year to date, year over year is 48% down, but year to date is 27. We just saw that number. That means there's half as many listings. So as an agent, I think to myself, wow, if there are half as many homes on the market, listings will be hard to get. If there's a couple agents on this call, listings will be harder to get. There are less to go around. So if you sign a listing, you got to make sure it sells, but you also have to make sure you know that there are half as many listings out there to even have. On the buy side, if there are less listings to sell, your buyers will get fatigued and frustrated more quickly. And as a buyer, like Stacey, you might be a buyer in the near future, you will find it more frustrating because there's less to look at and there's less to buy. And you're like, geez, is there anything going to come up? And, you know, we looked at those two houses, we didn't like them. Show me something new, Shannon. And looking all over the place, you know, and everyone's like, show me something off market. I'm going to tell you, most agents now, they're not going to sell stuff off market. When they have a listing, they got to put it on market. They want to get the highest price for that seller. And so when clients are like, can you show me something off market? And I'm like, anything off market right now, and whenever I see it, is overpriced. You don't want it. Or it's off market for the 2 weeks until they can get ready for market, and then it's on market. So we're not beating the market because that agent is like, oh yeah, I'll tell you about it, Shannon, but I got to get it on market, right? I would say the same thing. I have stuff when I have stuff off market, I'm like, yeah, I got this opportunity in San Pedro as a triplex, great opportunity investor. I got to put it on market, right? I got to get my seller as much as possible. I'm not taking any off market deals, and I'm not going to do any backdoor shenanigans with negotiating because I need to get that seller as much money. Not only for my reputation, but also because that's the best way to find these buyers that are out there. Unsold inventory, 2.9 months. So it's a little higher than the state average. What does that tell me? That tells me that sellers are overpricing their properties in Southern California above the California average. So they're trying to achieve start at a price that doesn't work. So it sits longer. Median days on market is 1 day less, somewhat negligible in my opinion, and sale price to list price ratio, it is under 100%, which means that people are overpricing it and they're taking, on average in Southern California, 3.6% less than the list price. It's an average. Still tells me though that the sellers started at a number and then realized it wasn't going to work, and so they're like, fine, I'll take less. That takes longer to get to that conversation, takes longer to sit on market and come to that realization. All right. Oops. Buyers are rate sensitive. So I loved this slide. Sales improve slightly as mortgage rates subside from a 20-year high. I'll let Sam kind of talk about the mortgage rate trajectory and history, because I saw there's other slides in there about that. But what I want to emphasize to you all is that as rates went up, look how it affected the number of buyers in the market, right? So we went from a high in January 2021 to we are below a 0 point average. So we're below that amount. very telling. It tells me there are less buyers in the market, but then I have to ask, can all those buyers find a home? And that is, the answer is no. So pendings. So just because the buyer is in the market, are they actually finding something? Pendings are also rate sensitive. So when the rates go up, buyers like, I want to hold. And then when rates come down, they're like, I'm back in. And I really encourage you, no matter if you're a buyer, an agent, or a seller, don't get rate sensitive, because you are like a herd of animals. You herd in when the buyers are herding in, they're herding out. As an investor, like most people, I don't want to go where the herd is. I want to go what makes sense, right? So people go where the herd is because they don't have any other way. They don't have any other way to gauge whether they should stay in the market or not. Instead, you should think about the fundamentals. Does this investment make sense? Is this a wise decision to pay this much more because of the interest rate, and then pay for it so that you can refinance in 2 years, which Sam, I know we'll touch on. So I don't want to take up too much of that space either. But yeah, I want to be really clear that we're down 41% in single family homes pending because we had less to sell and there's less buyers. And then condo and townhome in Southern California is down 46%. I'm sorry, this is statewide. So, right, next slide. Sam.
Okay, that's me. Okay, so back to what happened in 2022. There were 7 interest rate hikes. I'm sure you heard about each one. Just to be really clear, every time the Fed increases interest rates, and you hear about it on the news, that means that they're raising the prime rate or the federal funds rate, which is the rate that banks use to lend money to each other. So it doesn't mean that when the Fed says we're raising rates by another 1% next month, that doesn't mean that it's going to go from 6% today to 7% next month. Mortgage rates are affected by the Fed, but not direct. Your credit card interest rates, if you carry a balance, are immediately affected by that Fed funds rate. If you have a home equity line of credit, if you own a home now and it has a HELOC, a home equity line of credit on it, you have probably been hurting quite a bit in the last year because the interest rates went up by 4.25% on your HELOC. So if you had a HELOC in 2021 that was around 4%, right now you have a HELOC at 8.25%. So those increases immediately affect the HELOC. Now, every time the Fed comes and says we're going to raise rates again, it's because they're trying to help inflation. So as we all know, inflation's been very high. And so the Fed keeps saying we're going to raise rates, until we're in a stable economy, but we're not stable yet. And the Fed just came out saying last week, the chairman came out and said, yeah, we would love stability. We're just not there yet. But in the background, we are sort of getting there. As you might know, inflation numbers have been improving. The consumer price index came out last week saying inflation is lower than it had been than we had thought, right? Unemployment isn't as bad as we expected, which is very interesting to me. But anyway, all of that being said, interest rates have been coming down since October. October was the peak. So for those of you who are realtors on the call here, you may have had buyers who were like, we are not buying in the fall. No way, right? Because rates reached their peak of 7.1% on a 30-year fix. I almost fell out of my chair. I was pricing one at 9% for a bank statement loan at that time. And now we are seeing 6% again. We're actually seeing some under 6% interest rates. But it all sort of happened a year ago, almost January of last year. We saw a huge hike in mortgage rates, not because the Fed came out and raised rates, but just because the market just kind of went there. Then the Fed started to raise rates, but from December to January was a big change. December, we were looking at rates of like 4, which previously to that, Stacy, going into your question, we were in the 3s. We were in the 2% range in 2020. I refinanced people 2 and 3 times because the rates just kept going down and down and down and down. I don't ever expect the rates to go that low again. The 2 and 3%, as you'll see in my slides coming up, we'll probably never see again. But this spring, we may see, right now our rates are just under 6%. we may see just under 5% as the lowest rate that we'll see probably in the next 12 to 18 months. And then the normal average rate is usually about 7. That's the normal rate. We just, because of 2020, everybody's idea of where rates could be, we're so jaded. Anyways, so I think I've covered everything in this slide. If you can move to the next one.
Yep.
Okay, so prime. So what I said is on the last slide, prime right now is at 7 3/4. So that means for you, if you have a home equity line of credit, it would be probably a minimum interest rate of 7.75%. Plus there's usually some adds to it. So maybe it's 8 1/4, 8 1/2. But if you look at the history of where prime has been and the different rate hikes that the Fed has done, you'll see like back in the 80s, prime was over 18%, like off the chart, literally off the chart. And then as we got into, 2000, you saw it's coming down, coming down, coming down. And then just before, during the last big recession that we've all experienced, in those gray bars, those are all recessions. So interest rates come down, right? After the recession is over, they start coming down again. So you'll see the Fed lowered rates after the 2010 recession, and then kept them low. But then we started doing okay again in the late 2010s, almost early 2020s, and then 2020 hit, and we had another mini recession. See how skinny that line, that gray bar is. And so they dropped rates overnight in March once they found out that we were in a pandemic. And so that's when my phone started the hook. And so the Fed is going to control the economy by changing this rate and therefore affecting inflation. So, and then you'll see how the chart's going up and up and up and up again. I do expect another 1.5 interest rate hike. It might be 2 or 3 more rate hikes this year. A lot less than we had last year, but definitely there'll be some more. Keep going, please, on the slides. Okay, and so this is I know Shannon showed on her slides too, like where the rates have been. But as you can see, the average rate since 1971 was 7 3/4. Now, it never even got that high in the last year when we saw rates increasing. And rates increased at such a quick pace than anybody was used to. So you'll see a lot of first-time buyers came out of the market because of that. They were scared, right? They don't have the investor mentality. They have that emotion. They make decisions with their heart, right? Am I going to buy a house? Well, if I love it and the payment's right, yeah, right? But if I don't love it, I'm just going to stay where I am. I'm happier where I am. Everything's the same and I can control that. But as you could see there, interest rates, if any of you have parents, grandparents, or anybody who's purchased a home in the early 80s, right? Everybody talks about the rates were 18%, right? Yeah, they really were. But they've been trending down and down and down and down over the years. So it really wasn't until 2021 or 2022 that we saw such an uptick in rates. Knowing all of this, Stacy, now that you've seen this, hopefully you could see that likely rates will not go down like they were in the 2s and 3%. And the fact that this year already we're starting out the year with rates under 6%, that's way below the average of where it has been. So I would say, well, I would never see those low rates again, but I think under 6 is a great rate to get right now. All right, go ahead, please. I saw this statistic the other day, and I want to share with you. First-time homebuyers made up only 26% of all homebuyers in the year ending June 22, down from 34% the year before. So a lot of first-time homebuyers came off the market. So if you think about all those people who decided not to buy last year, all those people who had babies, people who got divorced, people who passed away, now their families need to sell these homes. There is so much pent-up demand. It's like this big tidal wave coming. And as soon as rates drop, and once people hear that what I'm telling you right now, the rates have already dropped, they're going to come back in. So that would mean the demand, right? Just from an economy, put on your, your business hat for a second. When you have all that demand, and Shannon mentioned still no supply, home prices are going to go up. So everybody in the country who's sitting by their TV thinking, yeah, I'm just going to wait for rates to drop and home prices are going to drop and then I'm going to buy. Is it going to happen, Shannon?
No, in fact, I heard that right away. I was like, no, you have to finish the sentence. That's not going to happen.
I know, but everybody's thinking that, right? I'm just waiting for rates to come down. Okay. Well, so is everybody else. And there's no inventory, especially here in the LA area. So, maybe in different parts of the country, you'll see a little bit more inventory. Specifically where I am in the North Valley, there is like just nothing. There is nothing to buy. And so, we'll see. Shannon said, which I was interested to hear, there's probably not a lot of inventory going up to meet the demand. And the fact that that tidal wave, right, of buyers that didn't buy are still going, they were going to want to buy now. And so that's going to make it with a multiple buyer situation where you're going to have to offer more, maybe it won't appraise, and you have to deal with all of that later on. Anyway, so that was very interesting. The lowest it's ever been for first-time home buyers in 41 years. That's pretty crazy, right? Everybody was so panicked by the rates. Okay, let's go to the next one. I don't know if I have any more. You want to go to the next one?
Yeah, can I say one thing, Sam? So one thing also to note is, so if those first-time home buyers left the market, but actually they were not only replaced, but really they got superseded by people that already owned property, had equity, sold it, and used that as the down payment. So suddenly with someone with 40% down and you working with a client with 5% down, and that 40% down person's like, yeah, I'll compete on price, and they go just a little bit higher than the 5% down person, they got that house. And so that 5% down person with these lower down payments, they're first time home buyers. Look, how can we save $450,000 to put down on a home? It's very difficult, but we can save $45,000, put 5% down, but we get in that category, that person gets exhausted. Like, how can I ever find a home? I'm competing with, you hear this a lot, I'm competing with all cash. I'm like, you're not actually competing against all cash. The other person that bought that home, they were financed. They just put a large down payment. It was their equity from the home they sold. They're not a first-time home buyer. That first home they sold was their first home. They are now a second home buyer or third, right? Or again, it's a lateral move. A married couple sells the property, but it was the wife that bought it before she was married, and then the husband and the wife buy there first. The husband's a first-time home buyer, she's a second-time home buyer. Again, these, you're just seeing where the first-time home buyer is essentially out of the market, even though they can afford. That's sad. I find that actually to be a tragedy, because from a socialist perspective, I really want home ownership to be available to everybody. And a 5% down person who can afford that $1 million home and cannot buy it has to either move down in price point or completely sideline everything they want in order to enter the market. And it is, in my opinion, a tragedy.
And that's also why home prices really didn't come down last year, even though rates went up, right? So a lot of the people who were more of a strategic investor or, had bought before, they're like, well, yeah, I don't mind putting a little bit more to buy that house to get it from somebody else because I have the cash because I'm going to sell my house, right? So everybody thought, oh, rates are going to go up and home prices are going to crash. They didn't crash, right? Home prices pretty much, they still actually appreciated. We had appreciation still last year in 2022, despite 7 interest rate hikes by the Fed. Okay, so we sort of covered this already. But when you have this pent up demand, right, and you have more competition for that same house, if you fast forward this year and let's say economists are right and rates do go down to like the high 4% range in March or April, and all this demand is all going to run out the door to go buy that $1 million house on the corner. If you instead think and try to be the smarter buyer and say, okay, I'm going to actually buy now in January, start looking at houses now where rates are around 6, you don't have to bid $1.10 million, $1.20 million, maybe 1.2 on this $1 million house to get it, right? Because there's less buyers. This is technically the time where it's quieter, right? Sellers who need to sell, Shannon always says, sellers who need to sell in the wintertime really need to sell. There's usually a reason. I've been finding people who are able, in some cases, right, depending on the seller, able to, get a little bit of a discount on a house, maybe have them pay for closing costs. or things like that. But I share this a lot, and you may have heard it as well, is marry the house, date the rate. So if you were to buy a house today with the rate being around 6 or just under, and rates drop at any time, whenever they do, if it's next month or they drop a couple years from now, you can always refinance. But at least you now own that house that you love and you got a great price for. But later you refinance. What's the cost for a refinance is usually the next question. Around $4,000. So it's not free. Even if you might hear somewhere that it's free, it's not. You pay for a refinance usually by adding the cost for the refinance onto your loan. So it seems free because you're not coming into the closing table with money, but it is being added to your loan. And it may cost a little bit more with taxes and insurance if you create an impound account. But thinking in that mindset of, okay, if I buy it now, I can always get a better interest rate later. But at least you don't have to have so much competition for that same house. All right, let's go to the next one. So there's always something, right? Even when I'm up at night thinking, oh God, rates are going to go up so much. What's going to happen? There's always new programs that come out. There's always a way to sort of tackle what the current situation is. So like I said, there are rates right now, 30-year fixed are around 6%, but you might be able to do an adjustable rate loan. Those have become a lot more popular, and those are somewhere around 5.25%. There's also a way, Stacy, to get your interest rate really, really low again, but temporarily, right? So that means the seller pays to buy your interest rate down for a few years. It's usually called a 3-2-1 buy down, where you get 3% knocked off your interest rate the first year. And then the second year, 2% off your interest rate, and then down 1%. So if your loan today, the interest rate was 5.85, then you could actually ask the seller to get that interest rate down to 2.85 for you for the first year. Then it would go to 3.85 the second year, 4.85 the third year. And then moving forward on years 4 to 30, you'd be at your 5.85. And yes, you could refinance during those 3 years. And the cost that the seller paid to get your rate down like that for you would, if you still have money left in there. So let's say it costs like $30,000 for the seller to do this. They may say, that's way better than doing a price reduction of 50 or 60,000 on my house. I'll do this for you, Miss Buyer, no problem. But let's say a year from now you refinance and now you have like 20,000 still left in that account that the seller helped you pull this rate down. You can then apply that to your principal. So you're never without this money. This is yours. You could refi anytime, but that's a really great way to temporarily lower your rate. And then likely in the next 3 years, you're going to refi anyway, because rates will come down a little bit more. There's also low down payment options. Like Shannon was saying, there's 3% down and 5% down, 10% down up to 2 million loan amount. Whereas before you always had to come up with 20 or 25% with the big banks on big size loans. So this is a way to do it too, because a lot of people don't want to liquidate all of their mutual funds and stocks because they've lost so much already. So this is sort of the way that investors are saying, well, don't worry, we'll still take you. You're a great buyer. You got a lot of money in the bank. Just put less down and you're good. There's also some bank statement loans and debt service loans for investors. So yeah, and I covered the big banks are requiring you now a lot. I don't know if you guys heard, but really big in my industry. Wells Fargo last week said they are no longer doing mortgages for people who don't have accounts with them. A lot of the other banks are following suit. Big banks don't make money. Mortgages are sort of a loss leader for them. And so you'll find that if you go to a big bank, their rates might be a little higher, or they might require you to move $250,000 over to them for you to even be considered to do a loan with them. So just make sure you're doing your homework if you're looking to buy. Obviously, at our company, we are not a bank. We don't manage any assets. We just do mortgages. So we don't require any money in any account to do the loan. But it's always good to know that no matter what the market is, there will always be a new program that comes out to try to entice people to come by.
So here are some of my predictions for 2023. I really think that I tried to narrow it down to one slide to probably, I kept thinking, I came up with a long list and I wanted to shorten it, mostly because I think these are the top ones for 2023. Listings are going to be from a must-sell seller. So probates, trusts, divorces, so it's life circumstances that are bringing people to market. You are going to see very few very few people that are just, I just want to see what the market brings me, or it's so hot right now, I might as well see if someone will give me this wild number that's like 6% above the average home price in their neighborhood. So no one's going to test the market. And if they do test the market, I think they're going to be disappointed. The market is finicky. It does not want to overpay. You might ladder up to a higher number than maybe the average in that area, but not wildly. Instead, you're just going a few percentage points above where the market would currently pay for anything. The home that I had on the market last month that just closed in Eagle Rock, we got 206,000 above, 204,500 above asking, because I priced it 100K below what I think it would sell for. And then I thought, well, there's plenty of comps that will support 200K above this. And lo and behold, we got 200K above that. So that was 100K more than I had anticipated getting in a downturning market between Thanksgiving and Christmas. We came on the market 2.5 weeks before Christmas. I said, price it aggressively so we sell it right away. I don't want to sit on market. But they were a must sell. They were like, I want to sell it. This is not a test the market situation. Number two, the buyers are willing to enter market when they can afford, but will not overpay. So kind of, I've sort of covered that in this conversation that we're having. So buyers are more price sensitive. So therefore the buyer pool is different. They're pickier. They want certain things. If they don't get it, they'd rather wait. I mean, whether they pay 5.75% or 6.25%, the rate is not making such a big decision because they've decided they're a buyer. So keep that in mind. If the buyers are so rate sensitive that a 0.5 point up, then are they really a buyer? Because you want to make sure they're going to buy. The rate will fluctuate way more in areas that are higher than 2 years ago, when we were at 2.75 to 3.5% interest rates, and buyers were not, so big deal, right? I just want to get a house. Now it's, I want a house, rate's not so important, but now I really want to make sure I get these certain things. But like things like the 3-2-1 buy down that Sam just mentioned, or a 2-1 buy down, because 3-2-1, I think it's pricey for how high our prices are. It's expensive to buy for a seller to buy that rate down. The seller that's trying to I'm not able to get one of these deals to work right now. It doesn't mean that the deals don't exist in the seller giving that 2-1 or 3-2-1 buy down, but I'm not finding that the sellers are willing to give that if they're unwilling to budge on the price. If they're willing to budge on the price, then we can make a deal happen. So again, were they really a seller in the first place? So are they a must sell? Inventory will remain low, holding prices constant at the best, right? I'm seeing averages for last year are up from the previous year, but we had a phenomenal January to August. So I think because we were still so high up in the pricing, January to August doesn't look so, that it skewed the first 3 quarters of data. So this year will really tell a lot more because we are really in the shift. We are experiencing the shift now. I absolutely, because I'm an investor myself, second home market is going to completely dry up. People overpaid for their second home these are the most common areas close to Los Angeles: Joshua Tree, Palm Springs, Big Bear, Lake Arrowhead. These were like on fire during the pandemic. People were overpaying, interest rates were still low. Well, that second home market, these people can't exit the market now. Like they paid $700,000 for that Big Bear property. They're hoping to get $700,000 now, and they lose money because of the closing costs and commissions. The second home, nobody wants to buy second home market because I have a client right now, 10.25% is the interest rate they have been quoted, with 1.5 points down. I was like, wow, that's expensive money. Investments are waning. So clients that are buying investment property as investors, they're not interested in traditional financing because it just doesn't look very appealing. You have to really want to invest in real estate and not live in it to really to make a commitment like that. So the opportunities for investments in 2023, I really believe that for investment sides, you're going to see more seller financing, where the seller, as long as they have a lot of equity, will increase the number of seller financing, where the seller becomes the bank. They're like, you know what? Instead of you paying the bank 10.25% with 1.5% down, I'll give you 9.5, 1 point down, right? So if I were a seller with lots of equity, I'm about to make 9% on my money. It's better than the market. It's better than the stock market right now. And let's just say I sell you my property and you give me a down payment so I can pay off my loan. So now it's paid off property. I'm the bank on it. I'm looking for those deals right now as an investor. I want to find someone who has a lot of equity, willing to use my down payment to pay off their loan, and then make a note for what is a reasonable amount, because it's lower than what the banks, the financial institutions are able to offer me. And then the seller gets all that money. I would pay 9%, 9.5% with 1 point down on something that does bring in enough cash flow. Outside of investing, larger down payments are going to become more common. So I think this would be just for any single family home purchase. You were looking at second and third home purchases for your personal residency. So Stacy, that kind of applies to you. You would have a larger down payment if you were to sell your property. And you know, there are sellers that are taking, you could even do 20% down and wait until you sell your property, and then but get into your next property without having to sell, and then deciding when you decide to sell for that other property to use that down payment on the home. So those are some of my quick predictions for 2023. Okay, we're at the end.
Nice to see you again. And we're going to have the next one March 16th. So we'll see you guys then. Make sure you get to come.